Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1609A, and today's date is July 6th, 2018, and the title of the episode is The Fed Goes All Out and Removes More Data to Shape the Economic Collapse Narrative. Let's get into the economic collapse financial news. Now, the central bankers, they've done many different things to get people away from cryptocurrency. And what they're seeing is that countries now are looking at the blockchain, looking at cryptocurrencies. There's many different corporations that are accepting Bitcoin to purchase their goods. And the central banks, they're kind of stuck right now. And this is why the head of the Bank of International Settlements, BIS, came out and said the following: cryptocurrency cannot assume the functions of money. Now, General Manager Augustin Carstens cautioned young people against trying to create money, and he was talking about Bitcoin. Went on to say that cryptocurrencies do not fulfill any of the three purposes of money. They are neither a good means of payment, nor a good unit of account, nor are they suitable as a store of value. They fail dramatically on each of these counts. He says cryptocurrencies, they're in a bubble. It's a gigantic Ponzi scheme. Well, let's look at the fiat system. I mean, if we really want to talk about it, it's created out of thin air. There's really no store of value. The only reason people use their currency is because they were able to weasel their way into governments, especially the United States, where they started the Federal Reserve. And actually, we don't even know if the whole entire law was actually ratified. And from that, it blossomed into many other central banks. And the Rothschilds have been doing this for a very long time. And what we're getting out of this is that they are very worried about people, and if you notice what he said, people, young people, trying to create their own currency. They're very worried about this because they realize if the people decide they don't want to use their currency system anymore, the central bank currency system, they know they will lose. And this is why they're continually trying to demonize the crypto market, the blockchain system. But it's not working. People are looking at this, and other countries are looking at this, and they're saying, you know something, it can be used for many different things, and it can be used as a currency. I mean, it's completely electronic. You can pay very easily with it. There's no problems. Now, if we look at the U.S. dollar, for instance, they're talking about store value. The U.S. dollar has lost 98% of its value since 1913. So how is that a store of value? And what they do is they just continually keep you looking at the cryptocurrency, telling you why it's so bad. And if you actually just take your eyes off of that for a second and look at the fiat or fiat system, you can see that their system is absolutely awful. And remember, when you issue something and you create a cryptocurrency, a coin, there's no interest attached compared to the central bank, where when they create their currency by pushing a button, they attach interest, loan it to the government, and the people then are enslaved to pay that back. So that is a very big difference. Now, here in the United States, we see the payroll numbers, the unemployment numbers, they've come out. And in June, the U.S. labor market continued to chug along. Now, remember, all these numbers are manipulated. They're not real. They go back and revise them. They leave people off of the count. And we've been talking about this for a very long time. And these calculations have not changed since the crisis. Actually, they manipulated them even more to make it look like the economy is doing a lot better than it really is. And we see that the April payroll changes, they were revised up from 159,000 to 175. And with these revisions, employment gains in April and May combined were 37,000 more than previously reported. And they had to do this because the entire system is breaking down. Now, the unemployment rate went from 3.8 to 4.0%, which really doesn't matter, but the labor force participation rate, it's bouncing around between 62.7 to 62.9%, and we are all the way back to 1970 levels. And we see right now that when people are not looking for a job, they still want a job, but they haven't been on an interview, they're just not counted as looking for a job. And we can see how they could skew all these numbers. Now, what's very interesting in the unemployment report from the BLS, it says that part-time workers, well, they increased and full-time workers declined. Now, we know there's a lot of retail stores that are closing. Toys R Us, for instance, just laid off around 33,000 people. We know a lot of other stores have been closing a lot of their stores. And for us to hear the news that part-time work has gone up, we know that this is fake, phony, and false. And remember, the people that are losing their jobs, especially in retail, if they aren't working a certain number of hours and making a certain amount of money per week, when they lose their job, it's not counted as a loss. But if someone gets a job part-time, making that, amount of money, working those hours, it's counted as a full-time job or a part-time job. So we see how they manipulate all these numbers. And we talked about vacancies yesterday. We talked about unemployment. We talk about GDP. We talk about retail sales. And statistics, it's very easily manipulated. And basically what they do is they just manipulate all these numbers to fit their narrative. We see out in Manhattan, the real estate bubble appears to have just burst. 54% of sales in the second quarter closed below asking price, and the lowball offers coincide with a significant 17% decline in sales versus 2017, resulting in the lowest second quarter tally since 2009. Now, Manhattan home buyers are getting bolder these days, demanding bargains, or they're just walking away from the deals in the market. And what we're seeing is individuals are lowering their price, or they're taking their homes off the market because they don't want to lower the price. We saw this back prior to 2008, where people put their houses up for sale. They started out at a very high price and they started lowering them a little bit, then lowered it a little bit. And then eventually they said, well, it's not even worth it. I'm not going to sell it. So they took it off the market. And what happened then, people were waiting for these prices to continually drop. And many people never really even went out to purchase a house because they were losing jobs on the other end. So we're starting to see the same thing occur once again, and it's just beginning. But we see out in Canada, Australia, Europe, those bubbles are bursting right now. We see Russian Prime Minister, well, he has signed a decree this morning imposing higher tariffs on U.S. products in retaliation for U.S. duties on metal imports. And really what's happening right now is that we have China, we have Russia, we have the U.S. with this trade war going on. And it's not the typical trade war that we might think of, because I think what they're trying to do here is they're coming together, working together to bring down the entire central bank system. Now remember, the central bank system is made up of many different pieces. We have the World Trade Organization, which we know that Trump is going after. We have NAFTA. TPP has already been struck down. We have the central banking system that issues the currency, and they're trying to take the global economy, and Russia already understands that the global economy is breaking down. China already understands the global economy is breaking down, and they're trying to rip this whole thing apart. And we see right now that Russia, well, how much longer are they going to stay in the World Trade Organization? How much longer is China going to stay in the World Trade Organization? And how much longer is the U.S. going to stay in the World Trade Organization? I think they're all working together to bring this system down. And like I said, each side is going to try to control the narrative. We have the central banks on one side and those who are opposed to the central bank. And we know that Russia has taken over their private Western central bank system, and they call the shots, not the Rothschilds. We see right now that the yield curve is flattening, and the Fed revealed that instead of thinking about backing off rate hikes, it's going to replace the yield curve, and I'll explain what that means in a minute. In the minutes of the FOMC meeting on June 12th and 13th, which was released yesterday, there was a doozy in there, obscured somewhat by the dynamics of the rate hike, plus the indication that there would be 2 more rate hikes this year for a total of 4, up from 3 at the prior meeting, with more hikes to come in 2019. And there were other changes that were all mixed in with this. But the big doozy in there, in the minutes, was about the flattening yield curve. Now, the yield curve is formed by Treasury yields of different maturities. Normally, the 2-year yield is quite a bit lower than the 10-year yield. Over the last several decades, each time the yield curve inverted, when the 2-year yield ended up higher than the 10-year yield, a recession followed. The last time we saw this was the financial crisis. So this has become a popular recession indicator, and it keeps popping up. And the Fed governors are looking at this, and they don't like it. They don't like anything indicating that what they're doing is bringing us into a recession. So they decided to do something very interesting. Instead of backing off, their rate hikes and doing all this other stuff, they're going to throw out the flattening yield curve. They're saying that the yield curve is an unreliable recession indicator. In other words, the Fed's massive balance sheet, 9 years of near zero interest rate policy, and other factors might be distorting investors' thinking. And this distorted thinking causes investors to pile into long-term treasuries at these low yields and then push down the yields further. So the yield curve is distorted. We can't look at that. It's not giving us the real information. No, what they're really saying is we need to cover up everything that we've done. We can't show people this data and have it, be reported on. So what are we seeing right now for the central bank to shape the narrative of this next collapse? Well, we had the Wall Street Journal saying that recession is coming in 2020. We had the New York Post, the economy is not doing as great as Trump thinks. We had the Business Insider magazine saying that the Fed says the tariffs might wreck the economy. The Fed discontinued the Fed balance sheet data, so you can't see that. And now they're throwing out the inverted yield curve because it is distorted. So think about this for a second. What are they doing? They are shaping the narrative for the next economic collapse. And we're going to see a lot more of this. And I didn't think it was going to happen this quickly, but it looks like they are really covering their tracks right now. And you can see that they're getting ready and prepared to bring this system down. And they don't want to have any data or information to show that they were the ones that did this. Why? Because they're going to point the finger. They're going to point the finger someplace else. And in the New York Post and in the Business Insider magazine, and we're going to see a lot of these more of these stories come out, they're going to start naming that Trump is the problem. And you notice with the Wall Street Journal, they're planning on doing this before the 2020 elections. It's already planned right now because they're stuck. They know the system cannot continue on like this, and they're very nervous and afraid that Trump and the Patriots are going to bring down the system and control the narrative. So we're headed for this major transition, and they've already started the process. Now, we talked about how they were raising the interest rates, and we talked about what happened last time when we hit the Great Recession in 2008. They slowly raised the interest rates. Looks like a little step going up. And when it hit a certain point and everything started to break apart, those rates fell like an elevator, dropping from the top of the building with no brakes. It went straight down. And what we're going to see once again, once we hit a certain point and everything really starts to fall apart, we're already starting to see signs of this, where the real estate market is starting to shake apart. We see Manhattan, we see San Francisco, we see Canada, we see Australia, we see Europe. They're going to take this to the next level, and we're going to see things really start to fall apart. I mean, we see the everyday consumer, they can't find high-paying jobs. People are losing their part-time jobs. People aren't making as much as they used to. Interest rates are still very, very low. So people really aren't earning interest on their savings that's in the savings accounts. And we know that the savings rate is continually dropping. The only thing that's going up right now is the stock market because they have control over this. But we see that everything else around what they've been manipulating is completely falling apart right now. And they understand that they don't have that much time. They need to start creating the narrative now. So when people look back saying, oh, yes, look, we saw this. Oh, yes, we heard this. Oh, yes, this is where it's leading us. That's why they're doing it right now, to gain the advantage of controlling this system coming down, and they're not the ones to blame. This is what they're trying to do. So we're going to see this battle continue on. And I believe that Russia and China and the U.S., they're working together because the eventual goal here is to get rid of the central banking system. So get prepared, get ready, because we're going to be going through this transition no matter what. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.